Let me tell you something that most traders completely ignore until it is too late. There is a war unfolding right now between the United States, Israel, and Iran, and the shockwaves from that conflict are moving through global markets in ways that will directly affect your trades, your open positions, and your account balance. If you have money in the markets right now and you are not paying attention to this, you are flying blind into some of the most volatile conditions we have seen in years. This video is going to break down exactly what is happening geopolitically, how it is translating into real price movements across oil, gold, currencies, and indices, and most importantly, what you as a trader need to do right now to protect your capital and find the setups that actually make sense in this environment. Not theory, not guesswork. Practical information you can apply before your next session opens. I have been trading and studying markets for years, and one thing I have learned is that the traders who survive big macro events are not the ones who are the most technically gifted. They are the ones who understand context. They understand that a single missile strike in the Middle East can invalidate every support and resistance level you drew on your chart the night before. Ignoring geopolitics is one of the most expensive habits a retail trader can have. Most retail traders I see on forums and in trading groups are still glued to their RSI and their Fibonacci levels, while the entire macro backdrop is shifting beneath them. They wonder why their setups stop working. They wonder why the market suddenly spikes through a clean level with no retracement. The answer is almost always the same. Something changed in the news flow, and they were not watching it. So here is what you need to understand first. The tension between the US, Israel, and Iran is not new, but what is happening right now has reached a level of intensity that markets are being forced to price in a genuine escalation scenario. That is different from background noise. When markets start pricing in a real possibility of wider regional conflict, the rules of normal price behavior temporarily break down. The key concept you need to understand to make sense of all of this is called a risk-off event. A risk-off event is simply when fear enters the market at a scale large enough to change how money flows. Investors and institutions pull out of riskier assets like growth stocks, emerging market currencies, and crypto, and they pile into safe havens. Gold goes up. The US dollar gets bought. Oil reacts based on supply fears. Stock indices drop. That is the cycle, and it plays out every single time a major geopolitical event hits. Right now, oil is the center of everything. Iran sits at one of the most strategically important positions in the world for global oil supply. The Strait of Hormuz, which runs along the Iranian coast, handles somewhere between 20 and 30% of global oil trade. Every tanker moving crude out of Saudi Arabia, the Way, Kuwait, Iraq, they all pass through that narrow choke point. The moment any military escalation threatens that passage, oil prices do not just move, they explode. We have already seen Brent crude spike sharply on news of escalating tensions. And here is what most traders miss. The first spike is never the last one. Markets overreact, pull back slightly, and then if the news continues to escalate, they push even harder in the same direction. The traders who understand this rhythm make money on both the spike and the continuation. The ones who do not understand it get caught short or get shaken out of a good long before the real move happens. Let us talk about what is actually happening on the ground, because context matters here. The US has been providing military and intelligence support to Israel throughout this conflict period. Iran has responded with direct and proxy attacks, including drone and missile strikes. The US has made it clear that any direct attack on American assets or personnel will be met with a response. That is not just political noise. That is a setup for a rapid escalation scenario that no trader should be ignoring. The market is now essentially watching three possible paths forward. The first is de-escalation, where diplomacy pulls both sides back from the edge and markets normalize. The second is contained conflict, where the fighting stays regional and markets adjust but do not panic. The third is full escalation, where the US gets directly involved in a military exchange with Iran. And in that scenario, the market reaction would be unlike anything we have seen in years. Gold would surge, oil would go parabolic, the dollar would spike, equities would crater. Now here is the part most trading educators skip over, and it is the part that will actually save your account. Knowing the macro story is only half of the equation. You also need to know how to read the market's reaction to the news in real time, because the market does not always go where logic says it should go. Sometimes bad news is already priced in. Sometimes the market rallies on what looks like terrible headlines because the reality was less bad than what was expected. The way you read this correctly is by watching price action at key levels on the higher time frames in the moments immediately after major news hits. If oil spikes on an escalation escalation headline, but immediately gets rejected and closes below a major resistance level, that is telling you the move was a fake-out reaction, and real sellers are still in control. If oil breaks through that level with a strong close and holds above it on the retest, that is confirmation the move is real and the trend has changed. This is not complicated, but it requires you to be watching and to know your levels in advance. Gold right now is one of the cleanest trades in this environment, and here is why. In every major geopolitical stress event in modern history, gold has been the first safe haven that institutional money runs to. It is not just retail traders buying gold. It is sovereign wealth funds, central banks, hedge funds. These are entities managing hundreds of billions of dollars, and when they move into gold, the price moves in ways that are sustained and directional, not random. If you look at gold's price behavior over the past several weeks, you can see a clear pattern of higher lows forming on the daily chart every time a new escalation headline drops. Each pullback is getting bought aggressively. That is not retail traders. That is institutional accumulation. And the rule in trading is simple. You do not fight institutional order flow. You find a way to align with it and ride it. The dollar is the second instrument worth watching closely right now. In a full risk-off environment, the dollar typically strengthens because global investors sell emerging market assets and park the proceeds in dollar-denominated cash or U.S. Treasury bonds. However, and this is critical, there are scenarios in this specific conflict where the dollar could actually weaken. If the conflict disrupts oil supply and oil prices surge dramatically, that creates inflationary pressure that could complicate the Federal Reserve's policy outlook. Inflation fears mixed with geopolitical risk is a particularly toxic mix for any central bank, and markets hate uncertainty around central bank policy. What this means practically for Forex traders is that you need to be extra careful with dollar pairs right now. The moves are going to be large, they are going to be fast, and they are not always going to be logical in the short term. Pairs like USD/JPI, EUR/USD, and GBP/USD can swing 150 to 200 pips in a single session on a major headline. If you are trading those pairs with tight stops and normal position sizes, you can get wiped out before you even have time to react. The Japanese yen is currently one of the most interesting currencies in this environment. Japan is almost entirely dependent on imported oil. When oil prices surge due to Middle East conflict, Japan's economy faces direct inflationary pressure, and the yen tends to become volatile and unpredictable. Historically, the yen is a safe haven, but in an oil shock scenario, that safe haven status gets complicated by Japan's energy vulnerability. This is exactly the kind of nuance that separates traders who make money in macro events from those who lose it. Let us talk about equities, because this is where most retail traders have the most exposure and the most confusion. The S&P 500 and other major indices have been trading in a state of elevated uncertainty for weeks now. Every time the conflict headlines get worse, you see selling pressure hit the indices. Every time there is a rumor of ceasefire or diplomatic movement, you see a relief rally. This creates a choppy, headline-driven environment where traditional technical setups have a much lower win rate than normal. The smart approach in a market like this is to reduce your normal position sizing, widen your stops slightly to account for the increased volatility, and focus on trades that align with the macro directional bias rather than trying to catch every swing. In a risk-off environment, that means being more willing to take shorts on indices and growth stocks, and more willing to hold longs on commodities and defensive assets. Fighting the macro direction is how traders blow up during crisis periods. Here is a mistake I see constantly during geopolitical events. Traders see a big candle on oil or gold and they chase it. They enter after a 3 or 4% move is already done because they do not want to miss the trade. Then the natural pullback happens, they panic, they exit at a loss, and then the price goes back to where they expected it to go in the first place. They were right about the direction, but wrong about the entry, and that cost them money instead of making them money. The rule that eliminates this mistake is simple. You never chase a candle that is already extended. Instead, you mark the breakout level, you wait for price to retrace and retest that level, and you enter on the retest with a tight stop just below the structure. This gives you a high probability entry with a defined risk. It requires patience, and patience is exactly what most traders do not have when they see a big move happening in real time. But the ones who wait for the retest consistently outperform the ones who chase. The energy sector stocks are also worth paying close attention to here. Companies like Exxon, Chevron, and Shell do not just correlate with oil prices, they often amplify the move because investors are buying future earnings expectations, not just current oil prices. When oil surges due to a supply shock, energy stocks can run 10 to 20% in a matter of days. If you are a stock trader and you are not looking at energy names in this environment, you are leaving very obvious opportunity on the table. Defense stocks are another area that historically benefits from elevated geopolitical tension. Companies involved in missile defense, cybersecurity, military equipment, and intelligence systems tend to attract buying interest when the probability of extended conflict rises. This is not speculation. It is a well-documented historical pattern that plays out consistently during every major conflict period. You can see it in the charts right now if you pull them up. Now let us bring this back to the most important question for every trader watching this. How do you make money in this environment without getting destroyed by the volatility? The answer comes down to three things: position sizing, timing, and alignment with the macro direction. Size down from your normal positions by 30 to 50%. Do not try to trade every setup. Wait for the setups that align with the overall risk off flow, and pay attention to the news calendar every single day, because in this environment, one headline can move your trade from profit to loss in seconds. The traders who are going to come out of this period ahead are the ones who treat this like what it is: an elevated risk environment that requires elevated discipline, not a time to take bigger risks because there is more volatility. More volatility does not mean more opportunity automatically. It means more opportunity for the disciplined traders and more destruction for the undisciplined ones. That is the reality of trading during a geopolitical crisis. I want to walk you through an actual scenario so you can see exactly how this thinking applies to a real trade. Suppose you wake up tomorrow morning and you see a headline that Iran has fired missiles at a U.S. military base in the region. Before you even look at your charts, you already know the immediate reaction. Oil is going to spike. Gold is going to spike. The dollar is going to spike against risk currencies. Equities are going to drop. Crypto is going to drop. That is the playbook, and it will play out within minutes of the headline. The question is not what direction, because you already know that. The question is, where do you enter without chasing? For oil, you look at the nearest prior resistance level. If price blows through it on the spike, you mark it and wait for the retest. For gold, same approach. For equities, you look at the nearest major support level. If price breaks below it hard, you wait for the dead cat bounce that almost always follows a panic drop. And then you look for a short entry on the retrace back up to the broken support level. This is not complicated, but it requires you to have done your analysis before the news hits, not after. The traders who are scrambling to draw levels after the move has already happened are always too late. The traders who had their levels ready in advance are the ones who execute with confidence and capture the move cleanly. Let me give you one more layer of this that almost nobody talks about. During major geopolitical events, the correlation between markets breaks down in unpredictable ways. Normally, gold and the dollar have an inverse relationship. When the dollar goes up, gold tends to go down. But in a true crisis, both can go up simultaneously because both are being treated as safe havens at the same time. When you see that happening, it is a signal that fear is at an extreme level and the move has momentum behind it. Similarly, oil and equities normally have a loose positive correlation in healthy market conditions. But during a conflict-driven oil spike, you can see oil go up while equities go down simultaneously because the market is pricing in the economic damage of higher energy costs at the same time it is pricing in supply disruption. When normal correlations break down like this, your multi-market analysis needs to become more nuanced. You cannot just use the same correlations you use in a normal market. The traders who lose the most during these periods are the ones who stick rigidly to their normal analytical frameworks and refuse to adapt. They keep saying the RSI says oversold, so I am buying, while the macro environment is screaming that every bounce is going to get sold. Adaptability is not just a nice trait in trading. In a market like this one, it is the difference between survival and account destruction. Now let us talk about how all of this directly connects to your profit potential, because that is ultimately why you are here. The oil trade alone during this escalation period has produced hundreds of pips of directional movement for traders who were positioned correctly. Gold has been even more consistent, offering clean trending moves on the daily and 4-hour charts that reward patient trend following traders. These are not small moves. These are the kinds of moves that can make a month of trading in a single week if you are in the right direction with an appropriate position. The traders who will miss these moves are the ones who are still focused exclusively on currency pairs and are ignoring commodities. They are the ones who have not updated their watch list to include oil, gold, and energy-related instruments. They are the ones who are using position sizes that were calibrated for normal volatility and are now getting stopped out by the increased noise before the trade can develop. Each one of these is a fixable problem, and the fix starts with awareness. If you are someone who trades Forex primarily, you do not need to abandon your pairs, but you do need to use them with an understanding of the macro backdrop. Right now, if you are looking at AUD USD or NZD USD, you need to understand that both the Australian and New Zealand dollars are risk-sensitive currencies that tend to weaken when global risk appetite drops. In a sustained risk-off environment driven by this conflict, both of those pairs are biased to the downside. That should be informing your bias on every setup you take. The commodity currencies like the Canadian dollar are in an interesting position because Canada is a major oil exporter. When oil goes up sharply, the Canadian dollar tends to benefit. So USD/CAD could actually trend lower during an oil spike, which goes against the typical risk-off playbook where you would expect the dollar to strengthen across the board. These are the kinds of nuances that separate traders who understand macro from those who are just pressing buttons based on patterns. This whole situation also serves as a reminder of why every trader needs a war chest, not a strategy, an actual cash reserve in your trading account that you do not deploy in normal conditions. When a crisis like this creates a clear directional move in oil or gold, the traders who have capital available are the ones who can size into that move meaningfully. The traders who were already fully deployed and over-leveraged before the event are the ones who either get stopped out by the initial volatility or are forced to sit on their hands while the best moves of the year play out. Managing your capital like a professional means preserving optionality. It means never being so committed to open trades that you cannot act on a new high probability setup when it appears. Most retail traders are fully invested all the time because they feel like idle capital is wasted capital. But the professionals know that patient, selective deployment is how you actually grow an account over time. The war chest is not dead money. It is your ability to take advantage of exactly the kind of opportunity this conflict is creating right now. If you have been watching this and realizing that you have been trading without paying attention to the macro picture, do not be too hard on yourself. Most retail traders start this way. The industry spends enormous amounts of time teaching indicators and patterns and almost no time teaching market context and geopolitics. But now you know, and knowing changes how you prepare, how you size, and how you trade. The traders who thrive in environments like this are not smarter. They are not more talented. They simply pay attention to a wider range of information, they plan before the market opens, and they execute with discipline when the setup arrives. That combination, awareness plus preparation plus discipline, is available to every single person watching this video. If this video helped you see the market differently, give it a like right now. It takes 2 seconds, and it tells me to keep making content like this that actually prepares you for real market conditions. Subscribe if you are not already, because the next video I am releasing covers something that catches almost every retail trader off guard during high volatility environments, and if you miss it, you will understand why so many traders keep making the same expensive mistakes when markets get wild. You do not want to be that trader. Stay subscribed, and I will see you in the next one.